Good day and welcome to our webinar for July. I'd like to start off by talking about Wall Street. As you can see on your screen, I've got the S&P 500, which is my preferred index for assessing Wall Street. And I'll just point to a few things here. You can see the record high at 28.72, which was made on the 26th of January this year. So this correction is now approximately 5 months old. You can see that the correction took the S&P down 10% to this low point here at 25.81. It then rallied and encountered resistance at this level here, which is 27.86, and then it fell back, and then it's rallied again to exactly the same level, 27.86, and then fallen back from there. But you can see that there's now a new channel, an upward sloping channel, which seems to be emerging, and we seem to have encountered that channel and we're bouncing off it now. So there's a little bit of a sideways movement here, and it looks like we're going to break on the upside here. And through all of this arrangement, the 300-day simple moving average still rising very steadily and nowhere near the index itself, which indicates that we're still firmly in a bull trend. The correction, as I said earlier, is 5 months old, so we would expect some kind of upside breakout. Of course, the first target will be this resistance line here at 27.86, and once that is broken, then obviously the 28.72 all-time high will become the resistance, and we expect that to be broken in due course as well. In other words, what we're saying is that this long-term bull trend is likely to continue. Therefore, this little correction that we've had, mini correction that we've had over the last 2 weeks, which has also impacted on the JSE, basically represents a buying opportunity for people that are not in the market already. And of course, when we look at Wall Street, we've got to understand that the S&P 500 is driven by events which take place in America. And the most significant event or events are that the Fed is now engaging in what are called open market operations. Open market operations. These occur where the Fed either buys or sells its own government bonds in the open marketplace. So of course, when they sell bonds, they are putting something into the market which is not money, and they are taking money out of the market. So that reduces the money supply. It's the opposite of when they buy bonds. Obviously, they're putting cash back in and taking their bonds out. So the Fed has decided to start reducing the size of the US money supply, the number of US dollars that are out there. And it's doing this by selling about $20 billion worth of bonds per month. By doing this, they are in effect reversing, in a very small way, the quantitative easing that they've done over the previous 10 years. At the same time as they've been doing this, they've also been raising interest rates steadily by 0.25% each time. And it's estimated that there are probably going to be another 2 interest rate hikes of 0.25% each during the rest of 2018. Now, if you combine that with the international risk-off attitude of overseas investors, it has put a lot of pressure on emerging market currencies, including the rand. Now, you need to understand that overseas investors, international investors, oscillate between being risk off and risk on. So when they're risk off, it means they don't want to take any risks. So that tends to cause them to pull out of emerging markets and invest in very safe things like gold, for example, or the US Treasury bill, which is generally reckoned to be the safest interest-bearing investment in the world. So then that process causes our rand to fall because they take their money out of South Africa and they put it into America. They put it back into US dollars. In May month, for example, the May month that's just completed now of 2018, foreign investors sold a net 20 billion rands worth of JSE stocks. At the same time, of course, they sold about 30 billion rands worth of our bonds. So that is why the rand has been under pressure, because these people have been withdrawing their funds from South Africa. And that has created pressure on certain stocks. A good example would be Capitec, where the share prices wallowed at around 860 or 850 rand per share. And that's the level it reached just shortly after the Viceroy report came out. That Viceroy report has been completely debunked, really, and the Reserve Bank itself has come in and said that they can see nothing wrong with Capitec's financial statements. The company is still going, but it's still wallowing at 850 rand. So that represents, in our opinion, an opportunity. Okay, so this is all putting pressure on the rand, as I said earlier. So let's go and have a look at that. If I can get it to work. Right, here we go. So I'm going to the rand chart that you're obviously very familiar with. Very important for a private investor to have a view on the rand, and I'm going to condense that and put 5 years data on the screen. And here you can see the upper and lower channel lines, which we've spoken about many times over the last few years. This point at the top here is where Nene was originally fired, and after a little bit of time, Pravin Gordhan was appointed. That signaled the change in the direction of the rand, and it started to strengthen between these two channel lines. This spike up here, which took it back to that trend line, was caused by the ANC's elective conference, where Ramaphosa was appointed. Once he was appointed, which happened about a month later, you had a very sharp improvement in the rand, strengthening all the way down to 11 rand 50, since when there's been some weakening. And this weakness here has been caused very substantially by the risk-off attitude of overseas investors. So overseas investors have been pulling their money out of South Africa, and not just South Africa. And in fact, the South African rand has been amongst the strongest of the emerging market currencies during this time. The Brazilian real, for example, has fallen 13%, and the Turkish lira is down 20%. So South Africa being down maybe 10% is looking a little bit better than the other emerging markets. Of course, trend lines like these channel lines are not 100% precise. They can be moved slightly one way or another. But what we are seeing now is that the rand is definitely testing this upper limit here, this upper channel line. And it's hovering around that 1375 area against the US dollar, and that is an indication that we may break up through this channel line and see a new weakening trend. If we go to the tick-by-tick figures here, you can see the actual minute-to-minute trades on the rand. And as you can see, the rand was a few days ago was trading as high as 1394. Since then, it's retraced back and now sitting at about 1370. So that 1370 level is below the trend line over here. So we're back below this trend line, but we're clearly flirting with this level, and it is possible that we could see a break through that level. I certainly hope that we don't, and our opinion is that we probably won't, but you can never tell. If overseas investors are sufficiently risk off, and if they're sufficiently unhappy with the ANC's progress in reforming our economy, then yes, you can see that rand go through that level and we enter a new weakening phase. And that, of course, brings us on to what is happening here in South Africa at the moment. What my perception is that the ANC is conducting a very carefully orchestrated balancing act. On the one hand, they're trying to do economic reform. Ramaphosa came in on the back of anti-corruption and economic reform, and he's been doing some pretty impressive things in that area in the short time that he's been president. However, at the same time, he is very aware of the 2019 election, which is imminent now. It's about a year away, and he's very concerned about losing populist support amongst the poorer people in South Africa who might vote, for example, for the EFF. Politically, the DA is still committing political suicide with all its shenanigans with Patricia de Lille, and I think that they are going to lose considerable number of votes in the next election as a result. The EFF, which is the other major party, has been forced to the left by Ramaphosa taking over the land redistribution issue from them, and the EFF has now become blatantly racist, especially after Floyd Shivambu went after Momoniat, who is an Indian and obviously very highly respected in this country, very highly qualified person, and it's clear that the EFF attack on him was completely racist. And it's an interesting situation that is developing in South Africa, because I think before this happened, the general consensus was that a black person could not be racist. Black people were the victims of racism. They were not the perpetrators. But here we've got a black person involved in a clearly racist statement against an Indian person. So this is, I believe, an element of South Africa's political maturity. What is being learnt is that black people are not exempt from being racist, and other races can be the victims of racism. That is a major step forward in this country, if what I'm saying is correct. All right, let's talk a little bit about the economics of this country at the moment, which is tied up in this balancing act which the ANC is trying to perform between economic reform on the one hand and preparing for the 2019 election on the other. And this is being clearly played out in the union activities in this country at the moment. First of all, the government has decided to compromise with the civil service unions. They've got 230,000 civil servants who belong to the union movement, and at a cost of 30 billion rand, they have compromised with those unions. So we are going to spend 30 billion rand more than was budgeted for in the most recent budget in order to accommodate the civil servants who have gone on strike looking for higher pay. Now clearly the ANC is going to at some point have to confront the unions, but it's also equally clear that they do not intend to do so before the 2019 election. That idea is backed up by the situation which is unfolding at Eskom, and I'll talk about that in a moment. But this extra 30 billion, which has now been added on to South Africa's costs to pay the civil servants more money, comes on top of a public debt which has doubled in the last 10 years and now sits at 53% of our gross domestic product. The ratings agencies are clearly watching this very closely, and they are concerned that our budget deficit is getting out of control. Obviously, if you're going to pay people more, the only way to cut your labor costs or your costs of employment is to cut down on the number of people that you've got employed. And so they are doing this. They've got now an early retirement plan for civil servants. So anyone who's over 60 can now look to retire on a golden handshake. And I think a lot of civil servants will take that opportunity to get out of the civil service and retire. That will obviously initially have a cost for the government as they pay out these retirement packages, but in due course it will reduce the number of civil servants, and that will reduce South Africa's cost base substantially. Now, of course, we had Mr. Hadebe, who is the new CEO of Eskom, brought in there to execute a turnaround at Eskom, and his decision was to offer the unions a 0% increase. A very brave decision, but of course very well justified, because Eskom is sitting with a debt of 367 billion rand, and is barely making a profit. Their product is being used less and less, and obviously they have to cut costs. It's interesting, for example, that the workforce at Eskom has increased by 50% since 2011, but the amount of electricity that Eskom produces has actually declined from 2011 to today. So obviously, again here, Hadebe said we must confront the unions, we must face them off, and then Pravin Gordhan stepped in, almost certainly on a direct instruction from Mr. Ramaphosa, from President Ramaphosa, and an instruction came down that a compromise must be reached. So now we're at the point where Eskom is offering 6.2% to the unions, and some sort of compromise will be established, but obviously, once again, at a cost to the taxpayer, at a cost to the fiscus, and it will make the public deficit worse, not better. Like I said, at some point we have to have a confrontation with the unions in this country. Very similar to what happened with Margaret Thatcher in the UK in the 1980s, where she confronted the union movement and broke the back of that movement so that the economy there could flourish. All right, I've got a few general points that I'd like to make before getting on to commodities and shares. I just wondered whether you realized that the South African Reserve Bank has been testing a new DLT, a distributed ledger technology, which is basically a blockchain technology very similar to that used for cryptocurrencies like Bitcoin. So they've been using this technology, testing to see whether they can implement it instead of the multiple option settlement system which they currently use, which is also called SAMOS. And of course, that test, having been successful, opens the door for many other registers in South Africa, government registers, to be converted to blockchain databases using distributed ledger technology. And I think of things like the e-Natus system, which is used to monitor all the motor vehicles in South Africa, or, of course, the voters register. All these registers are maintained by the government at enormous expense, and they are subject to being fiddled with and hacked. So I think that there's a huge potential for DLT, distributed ledger technology, databases to be implemented in the South African government. Another piece of news that came out since I last spoke to you is that South Africa has got its first artificial intelligence investor, produced or run by a company called NMRQL Research. And this is where they have implemented a program trading system where the computer literally learns from its mistakes and tries to always improve its effectiveness on the stock market, buying and selling shares. The problem is that since it was launched in October, it's down 2%. So you've got to understand that it's going to take a little while to learn what it needs to know. After all, a successful investor on the JSE needs to acquire experience over years and needs to have a very good intuition for the market. Nonetheless, it's an interesting development. One of the most disruptive technologies that's entered South Africa recently is in the convenience food area. You may not be aware of it, but a lot of AB income group people who have no time to look for recipes or shop for ingredients are turning to packaged foods. So there's a company called Silver Tree which is supplying these foods. They've now got a turnover in this country of 500 million rand per annum. They own brands like YouCook and Price Check, and basically what they do is that they will send you a week's food for you and your family, carefully apportioned so that each day's meals are accounted for and according to a specific recipe. And the recipe is available, so you can simply use those ingredients to cook up the meals and you don't have to waste time shopping and so forth. This is a very interesting development, and I think it's gaining traction. Obviously, you order the food online and it's delivered to your home, once a week, and that's your food problem taken care of. Also, there's very little wastage because the portions are exactly correct for the number of people that you are feeding. I also find it interesting that famous brands and Woolworths are also investigating and getting involved in this type of business. This is an enormously disruptive technology because it basically puts to bed, if it takes off to any degree, it's going to make supermarkets less applicable. And when you think of how many supermarkets there are, for example, in the Gauteng area or immediately around Johannesburg, this is a major change in the way that we live and think. It's online shopping coming to our doorstep. All right, let's turn our attention to the commodities sector. Of course, the big news here is that the third charter, mining charter, has been produced and is now available for public comment. And we've got people like Neil Froneman from Sibanye and Mgojo from Exxaro, who's the CEO of Exxaro. And they are on the one side of this, and obviously the Department of Mineral Resources on the other side. In this new document which has been produced for public comment, the once empowered, always empowered principle has been accepted. In other words, what they're saying is that if the company did a BEE project in the past and they supplied equity to their how can we see, previously disadvantaged employees, then that empowerment percentage remains on their books permanently, even if those BEE people sell their shares. So once they've received the shares on an empowerment program, that empowerment has been achieved. So that is one principle which will obviously make South Africa more investor friendly. But against that, the percentage which they are now required to achieve is 30%, and that's up from the previous 26%. At the same time, a 10% free carry has been allowed. So 10% of the shares in the company are now going to be split, 5% to the employees and 5% to the community where the mine is. And that 10% will get a 1% of the operating profit of the mine, which will be taken out of any future dividends that there are. Altogether, we think this third mining charter in draft form is not very investor friendly. It's a compromise. And in a compromise, nobody really gets what they want. I'm sure if Neil Froneman or Mgojo had a free rein to design the third charter they wanted, it would be much more investor friendly. And of course, the South African mining industry is under huge pressure. Platinum group metals have fallen further. The platinum price is below $1,000 an ounce. Recycling of platinum is growing by about 5% per annum. And of course, in the background is the spectre of electric motor vehicles. They are coming very much faster than anyone expected. They reckon that by 2030, 30% of the vehicles on the road in the world will be electric. The UK has recently tabled legislation which will ban internal combustion engines by the year 2040. It's an interesting situation, isn't it? But it kind of puts the kibosh on platinum as a metal. And talking about platinum, of course, we've got to talk about Sibanye, which invested heavily in platinum shares and platinum group metal shares around the world, and which is carrying a lot of gearing. I mean, the debt level at Sibanye is around 23 billion rand. Now, I've come up with a plan to reduce that debt by selling forward about $500 million worth of palladium from their Stillwater mine in America, and they've got another contract which should also yield about another $100 million. So if they can do those things, they will be able to cut their debt by roughly a third, which will make them a much better prospect as an investment. When you look at the share, it's now trading at about 9 rand. So let's just take a quick look at Sibanye. There it is. It's trading at 9 Rand. The net asset value is about 11 Rand. As you can see, the share price has come down a long way, but might be basing out here at this level. And they've of course had the bad news that they've had 21 deaths now on their mines in South Africa since the beginning of this year, which is about half of all the deaths on all the mining operations in South Africa this year. So they've clearly got a safety problem there, which will have to be taken care of. All right, let's look at the companies now. But before we do that, I want to just draw attention to something that's going on that you may not have been aware of, and that is that the JSE overall index has given us 3 consecutive, very interesting hammer formations. So I just want to look at that, and then we go on to deal with individual companies. Here you can see them. The first one occurred there on the 6th of February. A hammer formation is a candle, so it represents a single day's trade. And the definition is that the body of the candle, which is this part, the piece between the opening price and the closing price, must be less than half the size of the tail. And here you can see the tail. So that's the lowest price that the index reached on that day. And the difference between that and the closing price, which is this level here, is twice as big as the body of the candle. Now, whenever you get a situation like this, it's normally after a long downward trend, which you can see here, and it normally is the bottom point before an upward trend, which you can see over here. So a similar situation occurred here on the 4th of April this year. This was a much better hammer than that one, and as you can see, it occurred right at the bottom of this downward trend. And you can see the body is much smaller in relation to the tail. The third one occurred just the other day, on the 27th of June. And here you can see that the tail is obviously quite a lot bigger than the body, but the share went up, so there's an upward shadow as well. But again, it comes at the apex of the downward trend and just before an upward trend. So you've got 3 examples here of hammer formation coming after a downward trend and before an upward trend. And what I'm trying to urge you to do is to watch out for this important candlestick formation in the shares that interest you. It is usually at the bottom of a downward trend, and it forecasts an upward trend. What you have to remember is that candlestick charting was developed by the Japanese, and the Japanese view each day's trade as a battle between the bulls and the bears. So on a day like this one over here, the 4th of April, what you've got is that after a long downward trend, the bears tried very hard to force the share down to this low level down here, but they were unsuccessful, and the bulls managed to beat them all the way back up to this point here. So this is actually a very bullish formation. It signals that the bears have run out of steam at that point, and the bulls are taking control. And as you can see, following after that, there's a very strong upward trend. So you need to be aware of this. You need to use it in your analysis of your shares. When you see a candlestick like that, be aware. There is the opposite formation, which you see at the top of a trend, and that is called a shooting star, where you've got a very long upward tail, which is more than twice the size of the body of the candle. You'll also notice that with the hammer formation and the shooting star, the color of the candle does not matter. So it doesn't matter whether it's a green or red candle. That's not important. What's important is the length of the tail in comparison to the size of the body of the candle. That's important. It must be at least twice as long on the upside or the downside. Okay, so that's just a little bit of education on the subject of candlestick charting. All right, now the JSE Retail Index has been falling. Now, just a warning here, you will find this index under JSE-GENI, or if you're using the ticker symbol J272. It's called the JSE General Industrials Index. So you won't find it if you type in JSE-R. It's not there. It's under General Retailers or General Industrials. Sorry, it is the General Retailers Index, not the General Industrials Index that I'm looking at. So I'm just going to put it on the screen for you, but look for General Retailers and not Retailers. Otherwise you won't find it. Right here you can see how the retailing index has been falling pretty steadily, basically for most of this year. It's down about 20%, and that's quite significant since March. One of the interesting effects of this, and obviously this is linked to consumer spending. If the consumers are feeling a bit under pressure, they're not spending their money, then clearly that will cause the retail index to fall. And where we've seen it the most is in shares like Dis-Chem, which came to the market and were big favorites, went up very strongly to nearly 40 Rand a share. You just take that off. And let's put a bit more data on here. You can see we had this sideways pattern, this plateau here at about 35 to 40 Rand a share. And then down it came with the retail index, and we're now down here at 26 Rand a share. We think that the share is very cheap at these levels. Remember, you need to link this also to the risk-off attitude of overseas investors who pull their money out of shares like Capitec we mentioned earlier, and also Dis-Chem. All right, so I just want to draw your attention to that there may be opportunities now in retail shares because they've been heavily sold off. Now, the JSE also has a property index, which is called the SAPY, South African Property Index. Just want to see, did I get it? There it is. And you can see this property index, I want to put 1 year on the screen, so let's take that off. 1 year on the screen here, and you can see how the property index has literally collapsed this year. It's absolutely collapsed. It's down about 50% on what it was. And this, of course, is mostly due to the debacle surrounding the Resilient group of companies. Now, Resilient consists of 4 companies which are linked together. They are Resilient itself, Nepi Rockcastle, Fortress, and Green Bay. Those 4 companies. And they have cross-shareholdings and so forth, and they've been trying to clean up their act. But basically, there was a report from an asset management company called 361, which said that they were way overpriced and that the true value of Resilient was somewhere around 50 Rand a share. So let's just go and have a look at Resilient. And you'll see what I'm talking about. Right, so here you can see Resilient. This is the 65-day exponentially smooth moving average, which we recommended that you use in this situation where a blue chip share has fallen heavily. At the time that it broke down through that, the moving average was above 60 Rand. So the 65-day exponentially smooth moving average was above 60 Rand at this point. And it's now, sorry, I got that wrong there. Let me just correct that. Just put the data window over there. The moving average was at 141 Rand at the time that it broke down, 141 Rand. Since then, it has moved all the way down to this level down here, where it is today, 62 Rand. So basically what we're saying is that the 65-day exponentially smooth moving average has more than halved, and the share price came down, hit this bottom point here at 50 Rand, and it's been moving sideways since then. Our recommendation is that you don't buy into a company like this until it breaks up through that 65-day exponentially smooth moving average. Rather leave it alone. There may be other things that will come out of the woodwork. And we've seen that in other shares like, for example, Steinhoff, where we gave you the same kind of advice. Put on a 65-day exponentially smooth moving average, which is one of your indicators in ShareFriend, and then just wait for the share to break up. Here you can see the Steinhoff situation, where it's been falling and falling and falling We're now sitting, I think it's been as low as R1.20, R1.21 a share. We're now sitting here at 137, I believe. If we put on the line there, we can see that the index, the 65-day exponentially smooth moving average is now at 272. So with the price at 137 and the index here at, the moving average at 272, the price is still less than half of what the 65-day exponentially smooth, 65-day exponentially smooth moving average is. So use that moving average when you get a substantial fall in a blue chip share. So it's not time to buy into those shares yet. Here is a share that you could consider buying though, and that is Naspers. Now obviously Naspers is mostly consists of its 30% stake in Tencent, the Chinese internet company. They've got a 30% stake in that company. But I mean, Naspers produced a turnover of $20 billion in the most recent financial year. It is highly profitable, and we believe that this share is worth about 5,000 Rand a share. But as you can see here, it's trading for 3,400 Rand a share. So it's significantly underpriced. We reckon it's about 30% below what the share is actually worth. So if you're looking for something that's also got Rand hedge capability and you want something that's a blue chip that is underpriced, Naspers could well be the one that you need to look at. Of course, the problem with Naspers is that most of its shares are N shares, what are called N shares. These are shares with very, very low par value. They've also got A shares, and the A shares have got a par value which is 1,000 times more than the N shares, which means that their voting power is 1,000 times as great as an N share. So if you've got 1,000 N shares, you vote the same as one A share. That's really what it boils down to. Now, this kind of situation with N shares is frowned upon here in South Africa and internationally, and that's obviously why the share is trading at a discount. But it doesn't change the value of the underlying investments and assets. And we believe that at some point that N share structure will be dismantled and all the shares will rank the same. And as we say, this share, we reckon, worth about 5,000 Rand, trading at the moment for 3,400. Okay, folks, there's a lot more information in the notes, and I urge you to go to the website over the next couple of days and get those notes and read them. There's a lot more shares that we talk about and different things there. The notes are about 16 pages long, so clearly we cannot cover them all in this webinar, and all I've done here is to give you a taste, really, and I urge you to go and have a look at the notes and read up, and if you've got questions, let us have them. Otherwise, thank you very much for listening to us, and I hope to see you again or to talk to you again in about a month's time in August.